Okay, so this video is one of a number of videos that we have set out to look at the Boston HMDA dataset. That's a dataset that originally came from Manel, Tuttle, Brown, McInerney, 1996. And the dataset reveals some interesting headline statistics that minorities, so that's Latinos and African Americans, were 2 to 3 times more likely to be rejected for mortgage. The question arises, is that racial discrimination, or is that discrimination in terms of race that we observe, is it linked to other creditworthiness factors? In this video clip, we're going to consider loan to value and use the data set to determine if when we control for loan to value, is race a key determinant, or is there some evidence to suggest that banks in fact lend and don't discriminate along lines of race, that in fact they rely more heavily on creditworthiness metrics? So loan to value generally when banks determine if they're going to make a loan or not, or make available a mortgage to a mortgagor, one of the key bits of information to take into account is loan to value. Loan to value is a financial term used by lenders to express the ratio of the loan to the value of the asset. So when the borrower goes to purchase property, they may put in 20% their own cash and then borrow the balance to make up sufficient funds to purchase the property. If the borrower is coming with substantial self-funding, so if a borrower comes with 20%, 30%, 40% equity in the purchase, that provides banks with a buffer, so that in the event that the borrower ran into problems paying back the mortgage, then the bank could use the property, sell the property, perhaps in a fire sale, and recoup maybe 90% the value of the property on the market, and then would have enough to cover the mortgage. So in effect, what the equity is a form of buffer, and the more buffer or equity you bring into the loan, the safer the financial institution is from being affected by non-payment or a default by a mortgagor. The loan-to-value ratio is an assessment of lending risk that financial institutions examine prior to approving a mortgage. Loan assessments with high LTV are treated often as a higher risk, and therefore are priced differently, perhaps attracting a higher rate of interest. So sometimes we observe that when somebody is borrowing funds, if they come with a very high loan to value ratio, then they get charged a different rate of interest. Okay, so that's something of concern. Now, what we want to look at, just basically on the 2,380 or so mortgage applicants, could we break down what the loan to value distribution is with the applicants? So I've run that in OR, and we get this basic graph, but we're using the ggplot syntax, and we're setting it up as a histogram, and we can kind of see the distribution. And while there's a few exceptions here, generally you're not going to go much beyond 100%. Financial institutions don't like making 100% loan to value. 100% mortgages is a bit problematic. So there's a couple of exceptions here. We don't know what's going on. These are unusual, and they are more the exception than the rule. Okay, so taking that on board, then we can come down, run it again, and we can, well, first of all, what we might do is just remove the facet wrap for a moment, and we use the ggplot syntax, and we can consider the same graph as before, but we fill for denied. So we get the distribution of loan to value, but then maybe we'd like to consider the extent to which individuals are successful or not successful. So the deny no means you're approved, and yes means you're denied. And we can see there is a slightly increasing scale here as the loan to value goes up. There's a bit of a cliff effect, and I think once we go past 70%, we can observe there's a big jump. Now, there's also a big jump in the number of people in that cohort, so in proportion to each other, perhaps there isn't a significant increase. But our sense would be that the higher loan to value ratios typically would result in higher level of mortgage being denied, right? And we can play around with this diagram a little bit. I mean, to start off with, it would have been 2 perhaps, right? And we can see that when we run that, there are those 2 who had these astronomical LVRs, they actually were accepted. So that's kind of interesting, right? Now let's take those out of the picture because they don't tell us the whole picture, right? And let's say less than 1.2 and run again. And in this instance, we're filtering. So we're saying, let's take the all, we're going to call this all VR. So let's take all and then filter for less than 1.2. And then using that more limited data set, less than the 1.2. So taking the 1.2, fill in where people have been denied. So we can see that fill in. And then look at the distribution, and we can kind of see overall higher LVRs tend to lead to higher level of rejection. Okay, now it's a bit nuanced, and I'm going to put in here a facet wrap, so we break apart those who belong to minorities and those who are not. So when we run that snippet of code again with the facet wrap, we have on this side here groups who belong to minorities, groups who are not. Overall the level of denial is higher, but when we look at it, there isn't compelling evidence here that that the higher LVR in the African American and Latino group is producing a higher level of mortgage rejection. Okay, so perhaps we need another tool here, another metric, and in this instance we're going to use a scatter plot, and we use facet wrap. So we break apart the different consumer credit scores, so the 1 to 6, and we take in addition to LVR, we want to have a look at the debt to income ratio and see if we can observe something here in terms of the population. Now we can remove the facet wrap maybe initially and then layer it back in. So when we draw again, we have to be careful here when I run the line of code. In order to make our run, we need to load in a command. So that's at the beginning. So loan to value. Okay, let's go back. Let's just make sure we executed this line of code here, and then come back down to loan to value, and then just toggle down true and run this again. See, okay, so let's just pause and see if we can resolve. Okay, so I think the issue here is just that positive sign. If we take that out and then run. Okay, so we get this bigger picture then in terms of LVR to DIR, and again, the sense would be if you could maybe draw, I mean, when we look at the distribution of those who are denied and those who are accepted for the mortgages, there's a preponderance of red, perhaps this side, and a preponderance of blue more this side. So would suggest that as we go into higher LVR, higher DIR, there's a greater preponderance of mortgages being denied. If we then add in, layer in maybe the mortgage credit scores, right? Sorry, the CCS, consumer credit scores, we can see maybe that's more defined here in mortgage, in when the consumer credit score is 1, that's the best credit score. And when we move further into the worst credit scores, then we have more blue everywhere. Again, this is highly nuanced, and what we typically find with mortgage approval process, for many people, the lines, the rules, the guidance is bent a little bit more flexibly for some applicants and less so for others. Again, do we have evidence here? Let's just see with if we use the mortgage credit score here, do we see something similar? And with the mortgage credit score, yeah, with very few numbers in 3 and 4. The bulk are here. Mortgage credit score 1, they do better. Mortgage credit score 2, they obviously are doing a bit worse, a greater preponderance of blue. Okay, maybe there's another way of looking at this. Box plots may be something that might interest us. Just to look at the distribution, we saw that before, that some LVRs went up to 2. That's amazing, right? And it turned out those were approved. We could use more complex syntax with R, tidyverse, where again, we look at, in this instance, we're looking at the LVR distribution, and we're comparing those who were accepted against those who were rejected. So for a mortgage credit score of 1, we typically found people with higher LVR were being rejected, or those who were rejected on average, the median here was higher, and those who were accepted for mortgage had lower LVR, and we see that pattern in the data all the way through here. So that's quite interesting. All else taken into account, LVR, I mean, maybe we can make it a little bit more. Let's change that to 1.2. Run again, see what crops up. Okay, maybe it's a little bit more visible now, but we can observe higher LVRs. Those who are rejected seem to have higher LVRs. So applicants with higher loan to value ratios are being rejected more typically across all the credit scores, consumer credit scores. If we change that to the mortgage credit scores, we'll have 4 boxes, 4 categories. Do we observe the same? Yet again, it's quite a similar picture that we're getting here. Okay, so we can then move that down to where we say, let's take what we had just looked at, go back to the consumer credit scores for a second on that, and let's layer that with where we look at those people who are self-employed and consider what their experience is. And typically with self-employed people, those who are being rejected, those who are accepted had higher LVR, right? So if you're let's explain this a little bit. We have those who are accepted and those who are rejected. And with the self-employed, no. If you're employed, okay, so people that were self-employed, here, if we look at this, they are coming in with lower LVR, right, compared to those who are employed. And those again with but when we compare the self-employed, again, self-employed who were accepted, they had lower LVR than self-employed who are rejected. And employed people, so people who were employees, had those who are accepted typically are a little bit lower in terms of the LVR perhaps. Okay, so the trend probably is still there. Okay, now we can look at that and consider that instead of considering, we can do a little, maybe just refine that, maybe consider the mortgage credit score, run that. And I think the pattern is still holding, right? I think the pattern is still there. The self-employed people seem to be getting away with a lower LVR a bit, right? For those who are being accepted, but the overall people who are typically rejected have higher LVR in each instance. Okay. Now, instead of saying separating, bifurcating the population to those who are employed and self-employed, maybe we can look at this from the perspective of individuals who are part of a minority group. Okay, and this may be, this is how we're controlling perhaps a little bit for LVR, right? And it's worth giving this a little bit of attention. Okay, so what can we read in here? Well, we could, first of all, we could perhaps remove the facet wrap. So what if I just removed that for a second and get the overall picture? This then ignores the credit scores, the consumer credit scores altogether. And then we have here, is the individual part of a minority or not? So this is the minority and this is the rest of the population. This is the minority, this is the rest of the population. On the whole, we would say African Americans who are accepted, the median LVR is higher than the median LVR for the rest of the population. That would suggest that people are being accepted for mortgage, and perhaps we would say they're not being discriminated against, that the minority here, if a bank wanted to discriminate, the way they would discriminate, they would just arbitrarily look at the LVR, and maybe we would find the median LVR was lower for the population who are accepted. But in this instance, we're finding that the LVR, the median LVR for those who are accepted for mortgage, for minority groups, it is higher, meaning the financial institution is taking on more risk compared to the rest of the population. So just superficially looking at this, we don't have strong evidence here to suggest that the financial institutions are discriminating against African Americans. Now, what we don't have data on here is how's this risk being priced. And our mortgages are African Americans and Latinos being accepted for mortgages, but then they're put into a higher interest rate bracket and pay a higher interest rate over the life of their mortgage. There could be some issues there, but we haven't addressed, they're not addressed, I don't think, in this data set and in that paper. I know in recent times, some of the banks in the US have been fined heavily for arbitrarily putting African Americans and Latinos into higher risk category and then charging arbitrarily higher rates of interest, which is perhaps profit maximizing. But here, just at first glance here, we don't have evidence here that there is, when we control for LVR, that there is discrimination. Now we can remove, we can take out the pound sign and facet wrap that, then consider for different categories of consumer credit. And let's consumer credit score, which is 1 to 6, and then 6 being worst, 1 being best. And again, a similar pattern emerges here almost across the board. And then we can change that to the mortgage credit score, see what it comes out. And again, when we look at that, a similar pattern. Yeah, there's a very similar pattern in terms of LVRs that are higher being tolerated on African American population and Latino population, and that's not immediately a compelling argument here or compelling bit of information that says that there is discrimination. So, but again, we don't know how these mortgages are being priced. We're purely evaluating discrimination in terms of, did you get the mortgage or not? But what if you get the mortgage and then you pay a punitive rate of interest? That bit we haven't considered. and it might be interesting. Okay. Finally, then we could do some pivot tabling, comparing the mean. Now let's just see what we have here. So what we're doing, we take the entire data set, and then we say group by, and we want to pull out the median of the LVR and then count for each category. So basically, we're looking at yes and no, where you approved the mortgage or not, and those who approved the mortgage typically had lower median LVR. So that's what we would expect, right? And then we can run the same again, and we can say take that all data set and then look at deny, consider deny, and did denied mortgage insurance, and then compare for LVR. And those who had, again, the numbers are quite small, but typically if you're denied mortgage insurance and denied the mortgage, the median LVR for that group of 44 was very high. And what we can observe is if you were accepted for your mortgage, accepted for the mortgage insurance, the LVR was a bit lower typically, and that was the bulk. There was a group who were denied mortgage but accepted for mortgage insurance. Their LVR was a bit lower than this other group here. So that's interesting. We can then look at, okay, so that's LVR, I think, and maybe we should stop this video here.